Welcome back, everyone. With our batteries recharged with the lovely food downstairs, I think we are up for our next panel on financial services. A very warm welcome to all of you again. Financial services was one of our top sectors in terms of investments which happened in the PEVC industry in 2022, with about 4.5 billion flowing into this sector. It continues to be the investor favorite, topping the list of investor favorite sectors for FY24. To discuss what makes this sector so attractive, we have a stellar panel out here. Let me first invite on stage our moderator for this session, Ruchin Goyal, Managing Partner and Director, Boston Consulting Group. May I request you to come on stage, sir? Ruchin leads the financial services practice for Boston Consulting Group in India. He has extensive experience working with clients across financial services, including banks, NBFCs, asset management companies, and insurance companies. His experience has covered topics such as large-scale transformations, growth strategy, operational expertise, and organizational effectiveness. Welcome, Ruchin. Joining Ruchin is Anup Kumar Agrawal, South Asia Fintech lead at IFC. Anup currently leads Fintech investments for IFC in South Asia across payments, lending, insurtech, wealth tech, etc. sub-verticals. In the past, he has led several equity and debt investment transactions for IFC in South Asia, East Asia, and Africa across financial services space, including banks, NBFCs, microfinance, housing finance, broking, PVC fund, and whatnot. He has successfully managed exits, including through IPOs, and has experienced full investment cycles. Welcome. Our next speaker is Aseem Dhruv, Managing Director and CEO, SBFC Finance Limited. Aseem Dhruv has over 25 years of experience in the banking industry. Prior to joining SBFC, he was associated with HDFC Bank Limited as a group head, business banking, working capital and retail agribusiness. HDFC Securities Limited as Managing Director and CEO, and was a director on the board of HDB Financial Services Limited. Welcome to the stage, Aseem. Joining them on stage is Nritya Madappa, Partner 314 Capital. Nritya supports investments, top line and capital growth for the portfolio at the firm, and works closely with global institutional and strategic investors to drive growth of 314 portfolio companies. Her team partners deeply with portfolio companies in planning and achieving financial and strategic objectives, including capital raises, revenue acceleration, M&A, and exits. Before 314 Capital, Nritya founded and led the CoWorks Foundry, a business accelerator for early-stage companies, investing in over 25 companies and establishing global partnerships with Yale and Columbia University. Please welcome Nritya on stage. Our final panelist for the session is Sonali Jindal, co-founder and Kish and Ring. Sonali is a multi-hatter, presently #building Ring to serve the unserved millennials and offer them transactional credit. Sonali is a firm believer in digital lending and its massive potential in the Indian context. As a co-founder, she leads business initiatives. Sonali is passionate about financial inclusivity, business growth, and empowering high-performing teams. And she's curious about the role of technology and analytics in building a cutting-edge product, curate personalized customer experiences, and build user stickiness. I welcome all of you on stage and look forward to our panel discussion. Please give a loud round of applause.
Thank you so much. Good afternoon, everyone. It's my great pleasure and privilege to be a moderator for the Fintech Roundtable session. Now, Fintechs is a fascinating topic. We were just discussing before the session started. There are many things India can be proud of, but there is one thing that we can really be proud of as India, and something that we can really export to the entire world. It's the digital public infrastructure that has been created in India. In fact, as BCG, we do a benchmarking of maturity levels across all countries. For example, in payments, and the maturity stack for India is the highest, bar none, in the world. And what's happened is, because of this digital public infrastructure in India, we've seen a rapid rise of fintechs. In fact, India is the third largest home for fintechs in the world. Only behind US and UK, very close to UK, right? And you've seen a lot of innovation happening in India, a lot of money flowing in, and of course, last year has been a tough year. There's a talk of funding winter, and we'll talk about the funding winter, with all the panel members. We've seen valuations correct from anywhere 30-40% to as high as 70-80% depending on the fintech. But despite the correction globally, and this is not happening in India, despite the correction globally, our estimate is that fintechs still constitute around 10% of global financial services valuations, right? And we firmly believe that this is just a blip in the long-term secular growth of fintech. So fintech story is here to stay, despite the the winter. I don't know how long it will stay, but the fintechs are here to stay. So I'll start the discussion now with this panel members. The broad themes I would like to cover are around what trends are we seeing in fintechs around the world. How real is the funding winter, the funding winter, right? What can be the new innovations that that we can see? What have been some of the challenges, right? And finally I'll leave the floor open if you have any questions. For any of the panel members, please feel free to just raise your hand. We can take your questions. So, Anup, let me just start with you. You have a bird's eye view of not just what's happening in India, but kind of what's happening more broadly in Asia, but also around the world. What do you see as some of the key trends shaping the fintech industry?
So let me start or respond to this, one from global lens and then from India lens perspective, and then also from timeline perspective. So if we go back, let's say 10 years, I would, maybe not many in this room, but I have to pay electricity bills, I used to stand in queues, right? So that era has gone now. And today we are at a stage where just click of a button and we are able to pay electricity bills. So this is the new change which has come. So globally, everybody is thinking how financial services can be made available. It becomes more convenient, it's available at reasonable cost. So all those trends are very much there. So you put the point correctly that the long-term thesis that fintech is adding value and is going to stay is there. So that belief is there globally. And also in India, 5 years back I used to talk to banks that when will fintech really pick up in India? I used to compare, let's say, China or some other countries with India, and used to see, okay, a lot of fintechs have come up, but they are very small in size. So when it really scale up, suddenly we see it has really scaled up. So that's the trend here in India. In terms of, funding, let's say, if we see, 2 years back it was really moving up, valuations were through the roof, a lot of funding was happening. All of a sudden people have now realized, okay, things have changed a bit. So people have become more cautious. Now the funding has gone down a bit. Valuation levels are probably also settling down a bit. So that's the new thing. I don't want to talk a lot. There's a lot to talk, but I know there are things as well.
Thanks, Anup. And just kind of picking up, maybe I'll go to Nitya, you first, and then keep kind of going around the panel. As you look at the whole, funding being constrained and the funding winter, is that real? Is that for all kinds of fintechs, or are you still seeing money or interest by investors in some kind of fintechs?
No, absolutely. Thanks for that question. I think we talked about it, and a lot of my early stage peers in the room will agree that nothing has really changed for us materially. We're still seeing excellent deal flows within fintech. Finding really unusual business models, whether distribution models or innovative infrastructure pipes being built, it's still something that we are seeing very high quality founders building for. So deal flow is there. Deal making is still hotly contested. I'm sure my firm has gone up against a few of yours here on a couple of deals and fought pretty hard to win them. So I mean, from the earlier stage perspective, activity has remained stable for a bit there. Concerns around valuation and conversations, there was some mismatch around that, but that has also tabled where founders are coming to the table looking for more than just capital partners now, helping them navigate regulation and thinking through how they build product, etc. And we're seeing a very, very high caliber of founders raising at even like when compared to 2021 are incredibly depressed valuations. But that being said, anything past the Series A's have become very slow. Series B, Series C's, etc. There's a lot within that pool of capital that was investing in the mid-market and growth stages that deployed a large amount of their funds in 2021 in order to keep up and stay competitive, because of which a lot of them are now doing, scale back quite a bit and managing portfolios and all of the investments they've already made. There is significant dry powder in the ecosystem. We're seeing traditional growth equity guys, private equity guys come out of the woodwork, obviously looking for very different forms of business models than were in vogue in 2021. We're seeing fantastic consumer lending or SMB lending bets still getting funded and quite hotly contested, but the flavor of the month digital sort of plays are not as in favor with them. We're seeing rounds take much longer to close because everyone has the luxury of time now. There's not 3-4 competing term sheets and exploding offers on the table anymore. So much longer to close, much deeper diligence. We were talking about much more understanding and demanding on compliance. So requiring for you to be internally well structured, etc. So the requirements on growth companies and mid-market companies have just gone through the roof on what they need to have done in order to raise funding, and then they wait for 6 to 8 months while people make up their mind on the table. So that's unfortunately the slowdown we're seeing, but we expect it to come back as IPO markets also potentially start opening up towards the end of the year or lead up to the elections. So let's see.
All right, thanks Nithya. So the good part, from what I understood of your answer is that the interest in the early stage is still quite robust. So we can expect the pipeline of new companies that keep coming in the ecosystem. That's not slowing down, right? And of course, there's learning, for companies that are already there. So if I just kind of pick that theme, Aseem, you've been kind of running a company for a while now. What has been your journey? And as you look at the macro environment right now, and as you're preparing, for your company to also finally go public, what are some of the learnings that you can share, with that will be relevant for other companies?
So Buddha said that purpose is everything. What are you building? What is the purpose of what you are doing? If the chase is valuation, you will always end up wrong. There is no good market, bad market. There will be frothy markets where you may get your valuation. But if the intent is to create value, valuation follows. You just have to give time. People are in too much of a hurry. You cannot and should not become a unicorn too early. It's actually dangerous to become a unicorn too early, because what is important is that your business model has to ultimately create value for society. Only if it creates value for society in the long run will society allow you to stay relevant and keep creating value. So first is that when you lay a pipe of any business, especially if it is finance, the first thing is the regulatory construct. That it is super important. The only way you survive in a regulated world is by being the best boy, the monitor of the class. And the principal must love you, saying that if there is one boy which follows all the regulations and all the rules and is a very good boy, shoes is polished, my hair is always in place, that boy needs to be you. So at HDFC Bank, when I was there for over 20 years, and this is one big learning from that bank, saying that whatever you do, the regulatory compliances need to be at the top of everything you do. So that is the background and the bulwark on which you build. The second is that what are you building and what is your unit economics of what you are building? Because ultimately every business is going to get valued on profitability. So at some stage people may talk of growth, at some stage people may talk of innovation, but you have to understand that ultimately every business will seek to be valued on profitability. And especially as you come to the public market doesn't understand anything but profitability. So when you go to the public market, it is super important that all that you talked of in the private space is irrelevant. All the stories you gave to whomever is irrelevant. Ultimately, at the end of the quarter, what did you produce as a P&L and what growth are you doing on that P&L on a quarter basis without missing one single quarter. So what's important is that you get it regulatory right. You have to remember, Elon Musk also failed in one business. So many successes of his get talked about. Do you know which business really failed at? Fintech. He tried a startup called X.com, and later that went on to become PayPal.
Yeah.
But his vision on PayPal was not limited to payments. His vision was much larger. He wanted to set up a universal bank that would change banking in US forever. And he actually went on record saying banks are stupid. So it's about time somebody took them out. But it's not so easy because regulation and innovation don't go together. So that's one thing you keep in mind. Second is you get your unit economics in place. And third are processes. When you're building a financial institution, solid processes at the back end are non-negotiable. So it's super important that whatever railroads you build, the processes behind are extraordinarily strong.
Some great words of advice, Aseem. Thank you so much. I think all fintechs can really take this advice irrespective of what they're doing. If I move on to you, Sonali, you had quite a journey over the last 6-7 years running your fintech. How do you think the world has changed? What was India back then, and what do you see now, and what has been your experience?
Yeah, thank you for that question. I think very relevant. While the other panelists were answering their questions, I was thinking through it. Just borrowing something from Anup, right? He said in 2016, he used to pick the brains with the bankers and think that when fintech will get importance. So when we started in 2016, my relatives, my folks, the HDFC Bank folks that I work with, they used to check with me, oh, what is fintech? What do you do? I used to simply explain them, yeah, 1 minute mein loan de dete hain. And so many questions. So our claim to fame was being able to give loan instantly, right? But when I look at it today, I don't have to go back and explain anybody what fintech means. Banks in itself have departments which are catering to fintechs. Regulator is thinking about fintech, and that is the big change that we are seeing as a country. Now, talking about fintech to anybody is not like talking about something alien. Even to the investors, when they think about fintech, when they think about unit economics, when they think about what is the customer lifetime value, these concepts are not new. So it's a big transformation from a world which did not understand the word fintech to a world which understands fintech, which is thinking about, or the regulator is thinking about compliance. People are thinking about processes. People are thinking about the right set of people. People are also thinking that in this entire ecosystem of finance, fintech is an important part or an integral part of how the value will get created. So that's the big change I see. The other big change is that I think in our journey of the last 8 years, when we started, there was no digital infrastructure, so to say. There was no UPI, there was no Aadhaar penetration. Thinking about KYC, one used to think that how do I make the customer scan his KYC documents and send. And today one is thinking about a world where the entire lending is done on back of things like CKYC, video KYC, etc. So the entire infrastructure is well built. So we're talking about a new wave. I would say last 6-7 years were about getting the customer acquisition right. They were about building the right digital infrastructure. I think the next 10 years for us would be getting the capital structure right, getting the profitability right, making sure that how on back of the customers that we've acquired, we are able to prove it with confidence that I become a true part in the customer's journey. Because like Aseem mentioned, see, it's not about creating a $1 billion franchise, right? It's about creating true value for the customers or for the social benefit. So the next 10 years would be truly about being able to prove that here are these set of fintechs who are able to partner in the customer journey and truly deliver value for the customers that we've acquired. That is the way I think about it.
At one point, in this, so there is a lot of attention which gender financing has also got in the last few years. I just wanted to make that one point. That's it.
So that's it.
I think both gender financing and gender equality, when I was looking at this panel and wondering and then looking at so many women around, it is a lot of privilege to be a part of an audience which has women well represented and also be a part of a people which has women well represented.
Yeah, in fact, one of my colleagues in BCG, we just kind of catching up down and we've been kind of trying to associate ourselves with this forum. And a few years back, the entire conference could be done in somebody's house. 25 people turned up, right? And now, we need a hotel, and so it's quite heartening to see. So it's just building on our discussion. I think another, big theme in fintechs has been, will fintechs. There was a discussion at a point of time, like you said, Elon Musk said banks are stupid. A lot of fintechs thought they'll come and disrupt the banks. The banks will die, right? And fintechs will rule the space. To a model where now they're thinking should we disrupt the bank or should we collaborate, and any thoughts on how this thinking has changed, and maybe we can go back from you.
Yeah, I really think that we always thought of banks or this entire ecosystem to be very collaborative, because there is no worldview where fintechs would have unlimited access to capital. The true capital holders will continue to be banks. Fintechs definitely will become like the catalyst who are acquiring customers on the behalf of banks, and they are able to partner with the banks to provide right amount of services. I think one question which at least I thought in the script that was shared with me was about saying that what is the true participation that you will see from the banks, right, in the coming 5 to 7 years, or what are the services that fintechs will be able to provide and banks or fintechs won't be able to provide and banks will be able to provide. I think fintechs would really act as anchors for sourcing customers. Once those customers are sourced and there is a hook relationship that is created, the true providers of capital and the ability to give things like, say, home loans or own the relationship with those customers, that will always lie with the banks. So banks and fintechs, at least the way I think about it, it will be a collaborative universe where both the institutions come together. It can be an equity partnership or it can be a non-equity partnership, but it will be a collaborative universe where there are products that banks are offering, there are products that fintechs are offering, and they would be working in collaboration to kind of provide the right amount of services to the customers.
Thanks, Sonali. Nritya, if I just move to you, can you share some of your, experience, wisdom of investing in so many companies as to what should investors look at when they look at a fintech, especially when now, the market perception of what is value and valuation has kind of somewhat changed. So how should, investors going forward evaluate fintechs?
I think we're all in business because we answer this question differently, slightly differently. But one thing I do want to anchor off of her point is both of these incredible founders here come with that mindset of you collaborate with banks and very clear, mature understanding of the fact that they are at the end. That comes from having worked there or seen the belly of the beast and really truly the understanding of how massive this financial ecosystem is and what you can accomplish with them as partners as opposed to being like starting off with an antagonistic relationship, which is honestly in itself foolhardy. So just coming back to the point that you raised, when we do invest, at least at 314, we look at and like choosing our founders in fintech the same way you would look at maybe founders in health. Like I mentioned, you don't just need technical expertise or the willingness to impact it or the idea of a solution. You genuinely need to understand how deeply complex these industries are, how all the different stakeholders interplay, and how you need to put, say, real understanding and maturity about regulation and working with the regulator. Even there are a number of founders we've met who have never had a conversation with what is quite an open regulator in this country is just alarming. The RBI wants to hear what you're building. If you're in the wealth space, SEBI wants to listen to you. But just the way to engage is not something that exists in every founder. That it's first of all intimidating. Second of all, they don't know that there is an open dialogue there. So folks with heft within or just experience within the financial ecosystem in India, from whatever angle they did it, has been a clear marker of success for us, right? Whether it is the whole citrus pay mafia that came out and spun out, I don't know, 20 companies, wherein two of, actually probably more than that, both Open and Jupiter are from their founders there. Jitain is like a god, he's already built PayU as well and scaled it to such heights and then started Jupiter. The way he builds what he is building is very different from what we've seen other founders do, and that comes from, again, understanding, having been a banker himself, built financial, and every single time he gets an opportunity to speak with the regulator, he will be the first in line to have that conversation. So what we look for is the type of founder with an understanding and maturity of the financial ecosystem itself and a willingness to collaborate from day one. And knowing and coming with the patience of also working with extremely large organizations like banks, and knowing that very, very different stakeholders have different, within those banks itself have different things. So that's one very big thing. But other than that, again, several different theses, areas, we continue to keep scanning for the unique moat within a certain problem statement. For context, 314 looks at about 7,000 deals a year. That's the kind of coverage that we have within this ecosystem. About 30% of that probably is in Fintech, which means that if there is a specific idea, say cross-border payments in B2B or B2B, we have to ensure internally that we've seen every single team building for it, right, in a specific span. And then we make the pick of the team that we bring back. So the way we invest is like that within Fintech, and that has served us very, very well. And one more thing we lean on particularly in Fintech is us as investors also having that direct line to banks. Like we have 6 of our LPs actually are the 6 top banks in the country. 8 of the top 10 mutual fund houses are our LPs. So when they tell us that, hey, don't invest in this because you don't know the kind of thing I am building in cross-border, that's a very important piece of information for us. Or hey, regulation is coming in payments, or this UPI thing, like long back, for instance, 314 has not taken a bet in payments. We did that because of the advice we got from the ecosystem that this is more serious than you think, and the government is far more serious about this than just a nice little tech project on the side, okay? So take this seriously and know that the rails will get upended, and we don't know what will happen to MDRs, we don't know what will happen to transaction fees, so keep an eye on that. So being very cognizant that you're investing in an industry that is A, regulated, B, has very massive players who, by the way, have woken up to disrupt themselves at a pace faster, honestly, in my opinion, than what we're seeing within the fintechs itself. But there is a game to play, that those large organizations cannot move and tackle some of these problems with the speed and agility that is needed in order to tackle them, and that's where startups come in. So I know that was long-winded and hopefully hit on a few different things that set it apart.
I was talking to one of our investors, and he recently said that given you guys are running a fintech business, he wants to take a bet on people who just don't know how to launch a spaceship but also get it back. Because it's not e-commerce, right, that you burn money and then we'll see. It is fintech, you're building a systemic risk, and that's where so many learnings from the banks, that you put the right processes, you follow compliance, there is RBI who's looking at you, etc., etc. I think those things become far more important when you are dealing with a financial institution rather than dealing with any other institution in the country.
Great. Maybe just a time check. Maybe 1 or 2 questions from my side. But if anyone has questions in the audience, you can just raise your hand. You can take from the audience, or I can continue. No, I was just checking. Maybe you can just take time to gather your thoughts if you want to ask any questions. So I'll continue from my side. And coming to you, Aseem, just from your experience, not just running your company, but just looking at what's happening in India, right? Where do you think, the next wave of innovation, the new business models that get built by fintechs in India, what could be some of the new exciting, spaces, opportunities?
So, generally when we talk of fintech, we only talk of lending tech, but it is a lot more deeper. So when you see, what you need to understand is that where are the pots of gold lying? It is, for example, payments. Now, so much action was happening in payments, but the concept, so I'll tell you a little story. Vijay Shekhar Sharma was building Paytm very early on, and he had come to HDFC Bank to meet Mr. Puri and talk about what he's planning to do. So, he was very animatedly, I mean, if you have met him, you know what I'm saying, very animatedly, excitedly, he was talking about what he's going to do. So, 10 minutes, we heard him. And then he said, "Arey Sharma ji, mere ko bata tu paisa kaise banayega?" So, the point is that what you need to understand is where are the pots of gold lying. So, where are the pots of gold? The first pot of gold, which regulator will never allow you to get into, is liabilities. Access to cheap funds from the public. So the current accounts and savings account is the mother of all pot of gold that lies with banks. That is not going to disrupt, and that regulator will never allow you to disrupt it. So the biggest pot of gold, unfortunately, you cannot get into. Then the other pot of gold you have is the lending business. That what you build on lending, a lot of attempts have happened around it, more will come through. The third pot of gold you have is movement of money. So for example, cross-border, today, I've been thinking that why have companies not made sending out money so much more comfortable to accounts across the world? Why should we go through what we are going through now? But you need to keep in mind that UPI is also enhancing. So UPI is also now already talking of moving money to Singapore, and very soon more countries would follow. So the government, if you actually see what is happening in India, the real disruptor in chief is the government of India. The amount of tech innovations that they have done in the public architecture that they have laid out is absolutely fascinating. Yesterday I was coming back from Delhi, and if you download this app called Digi Yatra and link it to your Aadhaar card, it's a breeze. You go, there is no CISF line, so it was so beautiful that there were people standing in a huge queue outside Delhi airport to get inside and show your boarding card and ID, and there you go, you just scan it and you are in through. So similarly inside you also don't need to wait for a line. So now these are lots of changes of this technology on the public road infrastructure that is building. Then there is a health, and now health is also going to move into the digital space. The government is already doing a lot, more is going to come through. Now this will also open up an ability to finance health. That when health moves digitally, finance health, building insurance businesses. See, today for mutual funds, we have not realized how much it has got disrupted. Earlier, you could not be an AMC without having distribution behind you. So only an HDFC or an ICICI or a Kotak or an Axis could build mutual fund houses. What changed? What changed was, you had earlier to sell mutual funds, you had to do it through your own distribution. Now, performance-led mutual fund, because the intermediaries like Zerodha, etc., said we don't want to, but we don't need any commission. We'll do it free. So they are showing everybody which is the highest returning mutual fund options that you have, and you can just buy that mutual fund there. So now AMCs are coming through which do not have any distribution at all. So that cost has got intermediated, and now you can build performance-linked AMCs out there. So whether insurance, now InsurTech is also becoming a fairly large proposition, and IRD is also learning and facilitating some of that. So there are lots of these pots of gold out there which people will find ways to disintermediate the banks in certain places, but in other places you will have to collaborate with the banks. But in the end, if you have to remember that what is the core fundamentals of your business. For example, if you are a lending business, आपका सर्कस का तंबू 3 बम्बू पे खड़ा है. Cost of operations, cost of credit, and cost of funds. This is all there is to it. The guy who manages the lowest cost of all these three wins. There is nothing else to the lending business. Similarly, you have to understand that the people shouldn't confuse technology for a business model. It's nice to have a technology, but a business model is a different animal altogether. So you need to have the business model first, and technology is an enabler, because remember, technology in financial services can never be a moat in the long run. Everything is copyable and everything will be copied. The only thing nobody can copy is your execution and how you deliver the best and the lowest cost of funds, cost of operations, cost of credit.
Thanks. So I have two questions, from the audience, and I'll just pose them to take it. The first question is, what is the right time for fintechs to progress towards an NBFC license? So for the fintechs, I don't know, you want to take this?
I really think that fintechs can't operate. The lending fintechs, with all the regulations around, cannot operate without an NBFC license, because there are three core pillars. One, like Aseem said, you have to prove that there is a risk differentiation that cannot come in without you having your own capital and your own NBFC license. That is one. Second, I think the regulator has amply clarified that there is a role of a lending service provider and there are roles that are supposed to be performed by the person who acquires the customers. So that distinction, given the regulator has done it without an NBFC license, I really think it's very difficult for a standalone platform to operate. And the third thing is, see, the real operating efficiency really lies in you not just having a tech solution, in you being able to say that this is my true business potential. And if one has to truly demonstrate that business potential, both in terms of, say, your credit costs as well as in your ability to cross-sell and retain the customer, the NBFC license is an absolute must. So my view is that for a lending company to operate or a finance company to operate that plans to do lending, NBFC license is a must.
Great. Any other views on this? Saying every NBFC, so every fintech should.
It goes back to the thing that paisa kaise banaya. So if you are not going to have an NBFC, how are you going to earn money in your entire effort that you are doing? Because ultimately, in the long run, unless you are really holding a material part of the baby, otherwise you just become a digital DSA. And with all this cost, if that's all you're going to get, then it's not going to be viable for you to survive.
When we started in 2016, right, just to a Singh's point, there were two options that we had. One, do we become a fintech, which basically acquires customers and gives loans to those customers, or do we become like a marketplace? I think over years, what has been proven by the investors, by valuations, by how things have panned out, is that somebody who owns the customer, right, both in terms of being able to acquire and give out loans to that customer, that creates a far more successful franchise than you being just a marketplace.
Great. Please.
Just want to add here, that once you have an NBFC, then there is another challenge. And how do you fund? And that's where the angle of collaboration comes in. Like you either go to banks or another large NBFC or capital markets. So that's another thing that needs to be built along with it to ensure that the entire unit economics or everything works out.
Great. Another question is, when do you see the funding environment, improve, especially for the late stage, growth stage companies? Typically their valuations are at C, C, and B, have made them very expensive. So, how will this interplay, kind of get resolved? You should take please.
Okay, so frankly, it's a good environment for us. So, there was a situation 2 years back when it was very difficult to talk to founders, very difficult to get their attention. So now they are coming to us, they are talking to us, and they are giving us that required time. So, so it's a good environment for us. Let me put it that way. Overall, in general, in my experience of last 25 years, I have seen this happen so many times. If you go back to, let's say, the microfinance crisis, there was a time when nobody was willing to fund them. And then all of a sudden, they all have come back, right? So it has happened several times. And as we were talking very beginning of the session, that fintechs generally are adding value. There is no question about it. However, it should be run in a proper way. The execution should be done in a way that it is efficient, the unit economics work out. So those type of business models are still, in the current market condition also not facing any problem. So our portfolio companies, I don't want to name them here, but if you see in the news, people are raising 100 million plus if they're doing well. So if the team is good, if the business model has worked out well, they know how to lend and get back money. Let's say if you are talking about lenders, money is there on the table. Yes, the way the money was flowing in 2021, it was like not enough diligence happening. The bar was much lower. That has changed. Now the bar has moved up.
This is another thing that's always amused me, that there's too much talk about raising capital. We have to understand that capital sits on the liability side of the balance sheet for a reason. And when you raise capital, people congratulate you. It's like complimenting a chef for buying vegetables. The dish has to be right, right?
Still processing that was so well put. But I do have to say that funding interest has definitely not necessarily slowed down for the right kinds of assets, right? And that has informed. Actually, the best founders have just gone back to what they're best at and what they should be doing, and they want to be doing and be left alone is building businesses. We're seeing a lot of our companies where we're like 1 year in, one of our wealth companies is throwing 4.5 crores of monthly PAT for 1 year in existence, right? And they were like, no, that's how businesses should be built. Like if you're building a fintech and a financial services company, right, you should be able to make money in this business. It is the most like basic one-on-one. There are not that many complicated ways you can make money in this business, right? So going back to building, going back to that, that's actually, I've seen a lot of our growth founders honestly take it as a breather, that there is no real pressure to be continuously raising and turn inwards and build better. But yes, the capital is still there. I mean, these guys are getting chased. The ones who are throwing up cash like this, of course. Just outside this room, I got hunted down, being like, "Can you please make an introduction?" This founder is not responding to my email. I said, "He's not responding to mine." At least when I'm talking about race, company building, yes, we are definitely in touch. So that is also interesting. That the right founders have also looked deeper and they continue to build. So to your point, I think fintech, building in fintech and financial services doesn't need hundreds of millions of dollars to turn a profit. Some models, most models actually. So that's what they're focusing on now.
I think all the time in 2020, when so much money was pouring in, right? One of the things that used to happen was that we were always distracted. There was so much of FOMO that every day that you pick up the paper or you hear from somebody says, "Oh, I raised 100 million at a $1 million valuation." So the focus had shifted from building to raising, and we feel relieved that now the focus is back to building rather than raising. And all these efforts on collaboration with banks, thinking that there are pools of capital which are outside the equity capital, how do you think about leverage? All of these things are really emerging because now one has more time, more bandwidth to think about things which are beyond raising.
Apart from this, since you are going to close it, and this is the right forum, so therefore I want to make 1 or 2 points here. See, you asked about innovation for future. So probably one of the areas where innovation can happen is wealth tech for women. I was talking to one of the very senior persons, working in a bank, and she asked me that when will people start approaching me and telling me that, look, I can help you with your financial planning and I can help you invest. So that's the new area where things can actually come up. So innovation for future. There are many other areas we can talk about. There is not enough time. As IFC as an institution, there are few things that we track very closely whenever we invest in a company. So like, what's the gender ratio in the company? How many females are working? And we track it. That how many females are working. Also, in the lending companies, we try to see how many female borrowers are there. As entrepreneurs who are getting money. So those type of changes, and we are very clearly seeing trends there, and which are very encouraging. So I just wanted to share this because this is the forum where it should be shared. Thank you.
So one last thing I would say is that don't build a company, build an institution. Build an institution, something that will survive way after you. Because ultimately, that is the true joy. Everything else will follow. Build an institution, and institutions are built on solid bedrocks. So whatever you build it solid, build it to last. Don't read the economic times. Don't waste your time thinking about who's doing what. Have conviction in what you are doing and do the right thing every time. You know what the right thing is.
Thank you so much, and with that, I will just bring this to a close. Just to conclude, I think we had a very good set of discussions. If I will just take 2 lines to summarize, I think fintechs are here to stay, but I think fintechs have really realized there's a fin in the tech, right? Not just the tech. And and that skill is probably as important as the tech is. So thank you so much, everyone, and it was a pleasure for all of us being here. Thank you.
Did you manage to get it? Yeah, just take a group picture.